Hello, this is John Kvale of JK Financial, and this is your May Financial Planning and Capital Market Review, and I'm doing this outside. We have been in a gloomy Texas for about the last 3 weeks. I've got my red shirt on to try and brighten things up, and an up-pitched voice here to maybe my enthusiasm will help. For those of you that are driving, we do this in a video podcast format. So if you're driving down the wheel, if you're driving down the road, don't take hands off the wheel. I always get a kick out of doing that. Let's drive safe and be safe. So those of you that are in listen only mode, I am scrolling down the post, and the first post is a financial planning tip. It looks like we are opening back up. I had the neatest VP of marketing email me, and she brought to my attention her company and basically asked me to, not ask me, but said, hey, if you would like to use our website, just source it. So here we are. Those of you that are looking at the video, those of you that are listening, I've got a really cool graph. And the most important part of this graph, I would say number one, is this is a 2019, 2020, and 2021 comparison of TSA throughput. Had a couple questions on what that is. That's basically when the TSA checks you into the airport. They keep a public record of that, and that's where all this information is gathered. I wrote about a half a dozen posts going through the last year and a half, and I was pulling that information. Donald helped me with the graphs. They do such a better job. And basically, this lady just asked me to source her website. Here is, those of you that are listening on, I'm over a hot link. It's called flygents.com. You can slice and dice their website a million different ways, to the point where you can put your airport, your local airport, and the expected hourly times of when it would be busy. So if you're wanting to stay away from busy times, you can do that as well. Now, the second interesting point of this graph is they do an expectation. Now, I don't know how they do that. I didn't go into the details on this, but so we're at 2021. Those of you that are in just listen only mode, I've got the pointer over the current date, and they do a projection. So it looks like on their estimates, it's going to be about a September back to normal. Who knows? Everybody's so pent up that it looks like they want to get out to the skies again. And so anyway, I've got a link to this post that I talk about. This was kind of a break-in. It was on had some other information on it, but thought this was very much worth mentioning in our May review. Those of you that are in listen only mode, I am sliding down. Okay. I really kind of was very candid. And each article, each post that I do, I try and clear myself from the prior post, not even remember that I have done it. So I have a clear thought. I forget everything that I can do. I still remember that I've done the post, but when I'm writing a new post, I try and be totally just a blank spot. So I went back through May, and I was like, goodness gracious, all I was doing was talking about inflation or no inflation. Well, that's a good thing and a bad thing. Those of you that are in listen only mode, I'm basically just moving up to a neat graph here that is the JOLTS, the job opening measurement that the Bureau of Labor, U.S. Bureau, BLS, Bureau of Labor Statistics does, and it's at an all-time high. There are plenty of jobs out there which could be inflationary. We had some people talk about it being inflationary. But from the Berkshire Hathaway meeting that is highlighted here, those of you that are listening, I've got a hot link to that, to our job openings post, to one of my favorite speakers, which is the Robert Kaplan post, to the Malden Strategic Investment Conference, which had Jim Bianco and Lacey Hunt almost come to blows. They didn't really come to blows, but had they been in the same room, Lacey would have probably taken issue with Jim Bianco because they had such opposing views. Here's the deal. We don't know if inflation or any transitory inflation is coming, inflation more permanent is coming, or deflation. I don't know. We've got ways to monitor it. You're going to also see this in the newsletter. But we do know that each of those situations, transitory, regular, or slightly higher inflation or deflation, will have different effects. Primarily, if it's inflationary, it's likely to push interest rates up. If it pushes interest rates up, then that puts pressure on hard assets. Think the value of long-term bonds. Think the value of real estate. We have deflation, then that does just the opposite. If we have transitory inflation, then basically what we would likely have is we would have some pressure, and then we would be returned to norm. The neat part about this, and I bring this up in the newsletter, those of you that are in listen-only mode, I'm going back to the top of this post so that we can wrap this up. The neat part about this is we've got tons of measurements. We've got economic measurement, we've got the Federal Reserve measurement, we've got tons of way to measure it. So it's not to be feared, but it's neat to be monitored, and it's neat to reflect back on a month and go, wow, I really talked about that a lot. So it was top of mind. It was important by a lot of people that we respect and that we give value. I mean, Berkshire Hathaway, Warren Buffett and Charlie Munger have been around forever. So that is your May financial planning review. We will talk to you at the end of June, right dead middle in the summer. And we thank you for your time as always. Have a great day, and we appreciate you very much.